So, hello and welcome everyone. Today, I have a very special guest for you in the Wright podcast. I have Mr. Arun Sundaresan, who is the head product management group at Nippon India Asset Management Limited. He has a work experience of more than 20 years, all in the financial services industry. And last 19 years, he has spent with Nippon India Mutual Fund only. He has held various positions in sales and distribution, as well as a stint in corporate strategy. And now he is the head of product management group. His current profile involves developing and promoting investment-friendly mutual fund products and features. He's done his bachelor in engineering and chemical engineering from BITS Pilani. So Arun, I am also a chemical engineer by the way, and he's done a post-graduation in entrepreneurial management from TA Pi Management Institute. And he also has a CFA charter from the CFA Institute. So welcome, Arun. Welcome, Arun. We are so happy to have you here.
Thank you very much, Sonam. Thank you for having me on the show. Very happy to be interacting in this platform, and hopefully this will be useful to your audience.
Definitely. I think we always have a great time talking to folks from your AMC, right? So I think it will be quite exciting. So the topic of today's discussion with Arun is why investing in different asset classes is important, right? So we'll be talking about multi-asset portfolios, why multi-asset funds are important. And, Arun will be educating us about those products. So Arun, I'll just start off with the first question for you. Multi-asset funds have become very popular recently, right? A lot of investors are interested in these products. So why don't you explain what multi-asset funds are and what are their advantages and how are they different from a single asset product?
So multi-asset funds, as the name suggests, invest into multiple asset classes. In fact, as per the SEBI regulation, these funds will have to invest at least into 3 asset classes. So that's the difference. Unlike any single asset class fund, it could be an equity fund, it could be a fixed income fund, or sometimes hybrids, which maximum invest into 2 asset class like equity and fixed income. Multi-asset funds can invest minimum 3. Sometimes, they can invest into more asset classes as well. So that's the difference they bring to the table. Rather than invest in a particular asset class, you diversify in a single fund, you invest into multiple asset classes, right? So that's multi-asset allocation funds for you. Of course, we'll talk more about it as we go along in this session.
Arun, like you said, you have more than 3 assets in that fund. What are the advantages of having more than 3 assets in a fund? And, how would you explain that?
See, it's actually very simple, actually intuitive. If you reflect upon the performance of any asset class from time to time, right? One thing is for sure, it's very difficult to predict which asset class is going to do well, right? So when it comes to a single asset class, the performance, the risk return, and therefore the volatility profile of that asset class could be very high. Okay, so I'll give you some examples for you to relate to. So we are in 2023. Right. I'll take you through what happened in the last 10 years so that you understand what happens. So let's start with 2013. So 2013 was an extremely bad year for India. Okay, so we had the twin deficit. We had high fiscal deficit, current account deficit. It was so bad in 2013. Interest rates was very, very high. There was a risk that India's sovereign rating itself could be downgraded. Yeah. Okay, this was the scenario way back in 2013. Had you invested at that point in time in equity or Indian fixed income asset class, the returns were very, very bad. They're single-digit negative returns. Okay, and international equities actually, on the benefit of hindsight, in that year 2013 gave almost 50% returns, 50. Okay. Now, you wouldn't have expected this, right? The very next year, so this is so bad, equity did not perform well, fixed income did not perform well. The very next year, things turned around, okay? So 2014 calendar year, fixed income gave 14% returns, right. 14% returns. Equity markets again was a blockbuster year as far as 2014 was concerned. In fact, Towards the end of the year, we had elections and results were starting to come good, so on and so forth. Equity had a runaway kind of a year, which you wouldn't have expected given that 2013 was so bad. Suddenly, within a matter of 1 year, for things to change and these asset classes to give you good return, you wouldn't have imagined.
Right.
So the point in here, and I can give you one more example, a recent example. All of us are very familiar. 3 years back, 2020, we had COVID, right? So obviously, it was very, very unforeseen. We've never experienced anything like that, right? So it was very fearful. So you would have expected that equity would have collapsed, but 2020 turned out to be a very good year for equity. And gold, again, gave very good return in 2020 because for a good part, there was a risk aversion and people thought gold was a very, very good asset class. So one common thing with all this, we talked about 2013, 2014, 2020. 2014, after the strong government came in, people expected that equity markets will be very good. But 2015 and 2016 turned out to be a bad year for equity. Right? So against what you expect, you think that, okay, COVID has come, it's going to be disastrous. Unlike what you expect, a risk asset class like equity ends up doing. You think that there is a very strong central government and nothing can go wrong. It should be very good time for equity. Equity underperforms for the next 2 years, right? So this happens again and again, that you think that a particular asset class is likely to do well for X, Y, Z reason. What could happen could be quite the opposite. Right? So therefore, predicting or expecting a particular asset class to perform in a particular manner, it may not happen. In fact, if you go by history, oftentimes, quite unintuitively, the opposite of what you expect tends to happen. Therefore, rather than time the market, predict which asset class is going to do well, can you combine? Every asset class has its own time. They have their own day. So you just combine them, let it work. If something, one asset class were not to work at a point in time, something else works to compensate. And overall, over a period of time, your experience, your risk return tends to be much more palatable. So this is the concept of multi-asset funds.
All right. So that's very well explained, Arun. I think, you can't time how quickly the market shifts, right? And that's where these funds become extremely important. So in this world of extreme, a lot of diversification among asset classes, how do you think an investor can choose the right asset class to avoid volatility that is there in the market and achieve a stable portfolio?
Every asset class has its own characteristics, right? Equity, for example, over a period of time has the potential to generate very good returns. At the same time, it's relatively a risky asset class in the sense that the drawdown, the negative returns, volatility, etc., could be higher, right? So that's a characteristic of equity. So equity necessarily will have to be very long term. And when investors are investing into single asset class like equity, they should be prepared. I invest 100 rupees. Am I prepared for that 100 rupees to go down to 80, sometimes 75? You should be able to take it in your stride, right? So only then equity would be advisable for you, right? So this is the characteristics of equity. Similarly, another asset class like fixed income generally will be relatively stable when compared to some of the other asset class, but that can also have brief periods of flat returns or slightly less returns, etc. But by and large, returns would be more stable, and it'll accrue to you in a manner which is kind of relatively consistent. So that's the characteristic of equity. Similarly, gold also has its own characteristics, particularly when a lot of asset classes don't do well. There is risk aversion. For example, I told you periods like 2020, periods like 2013, globally, when a lot of things are uncertain. So asset classes like gold could do well, right? So every asset class, as an investor, when you're choosing, you will have to have a basic understanding of how these asset classes tend to perform over a period of time. You have the benefit of a lot of data, a lot of history about how these asset classes have done. So what kind of returns they've given, what kind of volatility or what kind of risk they bring to the table, etc. You'll have to be reasonably aware about how these asset classes behave and then accordingly choose. If you're a very long-term investor, if you're okay to take that risk, I don't mind if my 100 rupees comes down temporarily to 75, 80, I can wait for 2 or 3 years for that to come back and again, make return, then equity.
Right.
No, I want consistent return, even if the return is low, but I want it, more or less steady, then probably fixed income. And their characteristics, they may serve certain requirements, right? So you have the choice of investing into single asset classes. It's
Right.
not that, they are not meant for you. However, if you're an investor who thinks that, look, this is not my job to figure out which is going to do well, or on the other hand, I don't have the appetite to invest into one asset class and go through the volatility when that asset class suffers.
Right.
Multi-asset funds are a good.
That you said that there's advantage of investing in multi-asset funds compared to a single asset fund. So what is the extra advantage or what is the extra alpha do you think that multi-asset funds can bring for an investor, in comparison with a single asset fund?
So I think, more than alpha, whenever you talk about alpha, you're talking only about return. So you're talking about additional return when compared to a particular asset class. But the advantage, the main benefit of investing into multi-asset is not just return. So return obviously is important, but more importantly, how that return comes to you, right? Is it very high at some point in time, or does it drop down? Do you experience very sharp drawdowns? So multi-asset fund, by virtue of investing into multiple asset classes, combining different asset classes, tends to give you reasonably good return in the longer term. At the same time, your volatility, your drawdown, and certain risk aspects about portfolio and returns, so those tend to be far better when compared to single asset class. So basically, I would like to put it this way, that your risk-adjusted return is very, very palatable, right? So that's the big advantage of multi-asset funds when compared to single asset class funds.
Right. So Arun, will you talk about the flexibility of multi-asset fund and how that plays a significant role in the asset allocation for an investor?
Sure. See, multi-asset funds themselves, they adopt different strategies, even within the mutual fund industry. Okay. So there are different ways I can do multi-asset. So first and foremost is, what are the asset classes that I'm investing into?
Right.
Okay. So this is something that investors need to be clear about. For example, in the Nippon India multi-asset fund, we invest into 4 asset class, which is Indian equity, domestic equity. We also invest into fixed income, Indian fixed income. We invest into commodities, including gold. We also invest into international equity, which is global developed market equity. We invest into a MSCI World ETF. So in a way, this is a different asset class, because Indian equity is a emerging market, developing market equity, whereas MSCI World is a developed market equity. They tend to behave very differently. Right. So technically, these are 4 different asset classes. And technically, you can also say that one more asset class, which is currency, comes into play, because international equity as well as gold, these are dollar denominated. Right. Right. So the currency effect also comes into play for that part of the portfolio. So technically, 5 different asset classes is what you're getting benefited from. Okay. So the first and foremost is, what are the asset classes? In fact, as we speak now, none of the multi-asset funds in the Indian context right now, they invest into overseas equity. Okay. So they usually limit themselves to equity, fixed income, gold, and sometimes a little bit of other commodities like silver, oil, etc.
Right.
Okay, so this is one important consideration, saying what are the asset classes that you're making investments into, right? This is number one. Second, how are you making the asset allocation, right? So am I going to invest 70% into Indian equity, 10% in gold, and 20% in fixed income? Effectively, if you do that, 70% equity is almost like an equity hybrid fund,
Right.
right? So it may not be multi-asset. So how much are you investing into each asset class? That is also something that you need to keep in mind. It has to be a reasonably good allocation towards different asset classes. Only then you can call yourself a multi-asset fund. Okay, so this is another aspect that investors need to know about. If I'm choosing a multi-asset fund, how much is it investing into different asset classes? Is it reasonably adequate in each of those asset classes? Right? That's the second point. And the last point is the strategy. Do I invest a fixed amount, like let's say 50% I'll invest into Indian equity, 20% I'll invest into commodity, I'll invest another 20% into international equity. So is it fixed? That allocation, is it fixed? Or is it going to keep on changing? Right? If it's going to keep on changing, what is the basis? Is it a model, a market model which determines, how much I should invest into Indian equities now? Should I reduce? Should I increase? Or is it a view based? A fund manager takes a view. Oh no, today Indian equities look better. Let me increase. No, tomorrow, the overseas equities look attractive. Let me increase there. So is it view based? And you will have to keep in mind that more dynamic the asset allocation changes, whether it is model based or view based, that brings an additional element of risk and return, right? So I could be right, I could be wrong there. So if I believe that Indian equities are likely to do well, I increase allocation. If that call goes wrong, your returns will get impacted and vice versa.
Right.
So basically, to sum up, there are three things that you need to keep in mind. One, what are the various asset classes that the fund is making investments into? Is it in line with your expectation of investing into multiple asset classes? Second, how much is being allocated to each asset class? So sometimes some funds can call themselves multi-asset, but they may be investing very heavily. They may be tilted towards one asset class, and the other asset classes could be just for namesake, right? So that's the second point that you need to keep in mind. Third, how is the allocation being made? If you're saying that I am investing into a multi-asset fund, I want at any point in time reasonable exposure to different asset classes, then so be it. If on the other hand, if the fund is going to keep on increasing and decreasing, and that is very different from my expectation, that introduces another element of risk and return. Is that something that you want, or are you better off not having it? That's another point that you need to discuss. You need to think about and be clear about.
I understood that part, that the flexibility of how the asset allocation changes is extremely important. Now let's talk about what should like if an investor listening to our conversation becomes interested in a multi-asset fund, how should they choose a particular fund or fund manager to allocate their investment into?
Sure. So, as I said, multi-asset funds, the beauty of multi-asset funds is different asset classes coming together, right? So the basic endeavor is that different asset classes perform. So essentially, there is an element of unpredictability, which we explained, right, in the beginning of the conversation. So therefore, you're getting all the asset classes together in whatever proportion. So therefore, most of the multi-asset class funds is not about very active management, in the sense that you're trying to fiddle around with this stock, change, try and generate huge alpha. The basic essence is you're letting asset classes work for you. So get the asset classes together. Within asset classes, keep the profile reasonably conservative, right? You get the asset classes to the forefront and let them work for you. I mean, that should be the approach. So unlike a typical single asset class fund, equity fund, where the style of the fund manager's ability to generate alpha, you need to assess all that as track record. Here, the more important things to keep in mind, as I said, would be what are the asset classes that are working for you, in what proportion, are they managed within a reasonable range, or is it very dynamic? So you need to think about all these things and then choose for yourself what best would work. As far as Nippon multi-asset funds or multi-asset fund is concerned, we have kept it very simple. As I said, we are the only multi-asset fund which also invests into international equity. So technically, you have 4 asset class, which is domestic equity, fixed income, commodities, including gold, and international equity. The fifth hand, which is the currency, comes into play because some of these asset classes are dollar denominated, right? So what we have also done is that we have kept the allocation constant. So in Nippon India multi-asset fund, the domestic equity is fixed at 50%.
Right.
The international equity is fixed at 20%. Right? Likewise, commodity is fixed at 15%. Within that, gold will be at least 10%. Fixed income is fixed at 15%. So it is 50 plus 20 plus 15 plus 15. Okay. And why we have kept it this way is for the simple reason that as such, there are 4 or 5 different asset classes which are at work. Right. Now, if you introduce multiple dimensions saying that let me keep fiddling, let me make this 50 to 60 now, 50 to 40 now, reduce here, increase there, it brings in several additional dimensions of risk and return, which is not required. So this is a very simple, as far as we are concerned, a very effective way to make asset allocation, right? Every quarter, there will be rebalancing. Suppose one asset class is done very well when compared to the other, there will be profit booking. You will bring it back to the same asset class, at the end of every quarter. So at any point in time, as an investor, you're looking at 50 plus 50 domestic equity, 20 international equity, 15 commodities, which includes 10% gold, and 15 in fixed income. So we are letting each asset class participate reasonably in the portfolio, and we're keeping it simple, constant, and not introducing additional dynamism which may not be required. So this is the approach that we have taken. As far as I said, there are other multi-asset funds which could be taking a different approach. Therefore, if you're an investor looking for a very simple but effective multi-asset solution, according to us, the Nippon India multi-asset fund is a true multi-asset fund, so to say, that could serve. But in case you are evaluating any other fund, you need to think through, or rather evaluate all the 3 things that we talked about, saying what asset class, how much each of them are, kind of in the portfolio, and is it fixed or dynamic? If it is dynamic, how is it dynamic? Is the model robust? Is the fund manager experienced enough to take a call on different asset classes at any point in time and be correct most of the time? These are things that you need to ask yourself. If you don't think that's how multi-asset fund should work, the Nippon India multi-asset fund is a very simple and hopefully a powerful proposition.
Definitely. I think there is a lot of power in simplicity, right? And that's how you guys have sort of structured it. So now my last question for you, Arun, is that in this rapidly changing financial world, right, where asset classes come and go into very, very quickly, what is the future for multi-asset funds, and what do you foresee in that space?
A category which is popular even globally, right? So we were going through a recent report by BCG, Boston Consultancy Group. We cited that in one of our presentations. So multi-asset category is one of the fastest growing categories in the world. Today, all the multi-asset funds in the world, the total assets are nearly $16 trillion. And it is also growing very, very fast. This is amongst one of the fastest growing categories globally. That's number one. Even as far as India is concerned, right now in the mutual fund space, the total assets under management is roughly about 42,000 crore. 42,000 crore. This again is a fast growing category. In December 2022, this number was roughly 24,000 crore. Right. So which means that in a matter of almost 8, 9, 10 months now, this has grown by 75% already in this year. So I do think that this is a basic fundamental a good category of funds to have for all types of investors, whether they are a beginner, whether they are an experienced investor, whether they're looking at long-term wealth. That along with that, could come reasonably with a good experience, because it's not a single asset class, multiple assets work for you. I think this will tick the boxes. It will fit the bill for a lot of investors and will meet many requirements, so to say. Therefore, while it's already a popular category growing very fast, I do expect the popularity of this category to pick up, and for this category to emerge as one of the large and popular categories of investments for the mutual fund investors.
So thanks a lot, Arun. Thanks a lot for this wonderful explanation of multi-asset funds. And like you said, right, that in today's extremely volatile world, it's very important to have multiple assets in the portfolio. And that's why this category itself will become extremely popular. And like you said, that keeping a simplistic approach, not being extremely dynamic about how you shift your allocation, can be a very simple and elegant solution. It was a great session on the multi-asset funds. Any parting thoughts that you would like to give us, Arun?
Category, this type of funds are quite attractive. Not to say that single asset class funds are not. So obviously, each of them serve very, very different purposes. But whatever the type of funds, obviously, through such podcast and even beyond that, investors will have to do basic groundwork to understand before they get into a product as to what they bring to the table, what kind of risk return profile, and accordingly, have their expectations, rightly fine-tuned. So as long as they can do that, their overall investment experience will be pleasant, and most of their goals, they'll be able to meet comfortably. Multi-asset, of course, is a very, very special category, already quite popular with investors. After this session, probably, people can go back and, probably they can assess a little more, and based on their requirement, they can invest into these type of products. Thank you very much.
Thanks a lot, Arun. So this was a great explanation on the multi-asset category. I would, I would nudge my users, all our subscribers, to go and check out, different multi-asset funds, and check out Nippon India's multi-asset fund as well. And with that, we thank Arun for this wonderful session, and we'll see all our users in the next session. So thanks a lot and happy investing. Hello, everyone. So today's video is all about small cap versus mid cap.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to